Alright, this is Ubaid on behalf of Electronics, and in this video we're going to talk about the demand for reserves. Now, when it comes to the demand for reserves, okay, it works just like the demand for anything else within the economic system. Okay, so for reserves, okay, the way this works, okay, you have your federal funds rate, let's call it FF, and this is quantity of reserves. Okay, now as the federal funds rate goes down, the quantity of reserves goes up. And again, the federal funds rate is a rate at which banks borrow from each other. Commercial banks borrow money from each other. The interest rate at which commercial banks borrow money from each other. Okay, for that reason, when the interest rate goes down, okay, the quantity of money being borrowed for reserves goes up. As a result of which, what's going to end up happening is, okay, as the interest rate goes down, okay, banks tend to borrow more, not just to satisfy their reserve requirements, but also to get more in reserves so that they can prepare for the future. Okay, so as the quantity goes up, okay, the federal funds rate goes down, or as the federal funds rate goes down, the quantity of reserves go up. Now, at some point, okay, you have something called federal discount rate, and we talked about federal discount rate, okay, in the last video. So let's say this is FD, all right, and let's say this is a straight line over here, okay. Now, when it comes to supply, okay, when it comes to supply of reserves, okay, let's assume, okay, that this is your supply curve, okay, and this is what it looks like after it hits the federal discount rate, okay. So basically what's happening here is, okay, as the federal funds rate go up, okay, the supply of reserves goes up, okay, and as it hits the federal discount rate, okay, the banks are more interested in getting the federal discount rate because then they can sell the same loan, okay, the same money that they get for reserves at a higher rate in the market via federal funds rate. Okay, so to understand this, okay, let's say this is your demand and supply. Okay, as supply goes up, okay, as the quantity goes up, quantity of whatever it is goes up, okay, the supply goes up. As a quantity of something goes down, the supply goes down. Okay, when it comes to demand, as a quantity for something goes up, the demand goes up. Let's say this is price over here, and this is quantity. Okay, so as the price goes down, okay, the demand goes up. As the price goes up, the demand goes down. And for supply, as the price goes up, the demand goes up. And as the price goes down, the demand goes down. Okay, so supply is directly proportional to quantity, okay, when it comes to price. And when it comes to demand, demand is inversely proportional. Okay, the price at which you have demand is inversely proportional to your quantity of anything that you're selling in the market. Okay, so having said that, okay, again, if you look at this curve over here, the supply curve is more like an L-shaped curve. Okay, the demand for reserves, even though it may go down, okay, as the interest rates go up, okay, or the federal funds rate go up, the supply of reserves, okay, goes up, okay, as the federal funds rate goes up until it hits a certain point. This is your federal discount rate. So this is the rate at which the central banks, okay, lend their money to commercial banks. Okay, and obviously commercial banks have to pay a certain amount of interest. Okay, now assuming that this interest is stable, is the same, okay, what's going to end up happening is the demand will become, okay, let's say this is infinitely elastic, okay, because obviously as soon as they hit the mark over here, which is your federal discount rate mark, okay, the banks will need more of this loan, okay, because they will borrow from the central banks rather, excuse me, and then they will sell the same loan, they will sell the same money that they borrow from the central bank at a higher rate in the market to other commercial banks via the federal funds rate. Okay, it's kind of like borrowing money at a lower interest rate and then selling the same money in the market at a higher interest rate to make profit. And that's the reason why the supply becomes infinitely elastic at this point. So that will be it for this video. On behalf of Electronics, this is Ubaid. Have yourself a great day.